So let's go through some of these in more depth. So a bad debt is an outstanding balance of an accounts receivable, which is unlikely to be recovered from by a business. So when you offer credit to customers, that means that they can pay using their credit line, so they don't have the cash to give you then and there. And then bad debts are when those customers then can't ever give you that money. So it can be an individual or an organization, and they're not going to pay that debt. So that becomes a bad debt, aptly named. Now, doubtful debts is when you're thinking that it's uncertain whether those debts will be paid to the business. So provision for doubtful debts is accounting for that. So it's the projected amount of bad debts that will stem from those unpaid accounts receivables. You are putting in a provision, so sort of making that allowance for what is likely to happen. And the provision for doubtful debts decreases the accounts receivable figure in the statement of financial position, because it is what we call a negative asset account. And we'll have a look at what those are later on in this session as well. So if you're thinking that you're not going to receive these payments, then you're reflecting that by decreasing that accounts receivable to show that it's not as high as it otherwise would be.